Hello and welcome. Today, we dive into the world of investing, specifically, how to invest in the S&P 500. The S&P 500, or the Standard & Poor's 500, is a stock market index that represents the performance of 500 large companies listed on the stock exchanges in the United States. Essentially, it's a numerical indication of the state of the U.S. economy, based on the performance of these top companies. The 500 in its name isn't just a fancy title. It signifies the breadth of the market coverage it provides, encompassing a wide range of sectors. The S&P 500 is often considered the best single gauge of the U.S. large-cap equities. But what does that mean? Simply put, large cap refers to companies with a market capitalization value of more than $10 billion. These are typically well-established companies with a history of performance. Why is the S&P 500 popular among investors, you might ask? Well, it's due to its diverse representation of the market and historical returns. By investing in the S&P 500, you're essentially buying a small piece of the top 500 companies in the U.S. This allows investors to spread their risk across many companies rather than betting on a single stock. Moreover, the S&P 500 is known for its strong historical performance. Over the long term, the S&P 500 has delivered an average annual return of around 7 to 10% after adjusting for inflation. This makes it a compelling choice for investors seeking steady growth in their portfolio. However, like any investment, the S&P 500 comes with its own set of risks. The value of the index can go up and down based on economic factors and market sentiment. Therefore, it's essential to understand these risks before making an investment decision. Now that we understand what the S&P 500 is, let's explore how you can invest in it. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Before we dive into the process, it's crucial to understand the basics of investing. Now, investing may seem like a daunting task, but when we break it down, it's all about three core concepts: diversification, risk tolerance, and the difference between long-term and short-term investing. Let's start with diversification. Imagine putting all your eggs in one basket. If that basket falls, all your eggs break. That's why we diversify. In investment terms, diversification means spreading your investments across various assets to reduce risk. It's about not putting all your money in one company or one type of asset. Instead, you spread it across different sectors, different types of investments, and even different geographical areas. Next, we have risk tolerance. This is a personal aspect of investing. It's about how comfortable you are with the potential of losing money in the short term for a chance to make more in the long term. Everyone's risk tolerance is different, and it's important to be honest with yourself about yours. It influences the kind of assets you should invest in and how much you should diversify. Finally, there's long-term versus short-term investing. Short-term investing is like a sprint. It's about making quick gains, but the risks are higher. On the other hand, long-term investing is a marathon. It's about growing your wealth slowly over time. It might not be as thrilling, but it's generally less risky and can lead to significant returns over a long period. Remember, investing isn't about getting rich quick. It's about growing your wealth over time. It's about understanding the market, being patient, and making informed decisions. It's about being okay with ups and downs and knowing that in the end, the trend of the market is upward. With these basics, we are ready to explore the process of investing in the S&P 500. Investing in the S&P 500 begins with research and planning. This is the golden rule when it comes to investments. Why, you ask? Well, because understanding the nuances of the S&P 500, its past performances, and aligning it with your personal financial goals is not just sensible, but crucial to building a successful investment strategy. Now, the S&P 500 is a market capitalization-weighted index of 500 of the largest publicly traded companies in the U.S. It's often considered the best single gauge of large-cap U.S. equities. But what does all this mean for you as an investor? Simply put, it offers you a chance to diversify your investments across a wide array of sectors and companies, thereby spreading out your risk. So, how do you go about researching the S&P 500? You start by understanding its history. Look at how the index has performed over the years, understanding the trends, the highs and lows, the impacts of global events, and the overall growth trajectory. There are numerous resources available online, including financial news outlets, investment research websites, and even the official S&P 500 website, where you can find detailed historic data and analysis. But remember, past performance is not a guarantee of future results. Hence, your research should also include understanding the current market situation, the economic outlook, and the potential risks involved. Now, once you have a good understanding of the S&P 500, it's time to plan. This is where your personal financial goals come into play. Are you investing for long-term growth, retirement, or perhaps a short-term financial goal? Your investment strategy will largely depend on your answer to these questions. For instance, if you're looking for long-term growth, you might be more tolerant of short-term market volatility. On the other hand, if you're saving for a short-term goal, you might want to take a more conservative approach to protect your investment from market fluctuations. In essence, research provides you with the knowledge, and planning provides you with a roadmap. And when these two come together, they form a solid foundation for your investment journey. Once you've done your research and planning, you're ready for the next step, opening a brokerage account. The second step is to open a brokerage account. So, what's a brokerage account, you might ask? It's essentially an arrangement that allows an investor to deposit funds and place investment orders with a licensed brokerage firm. In simpler terms, it's like your bank account, but it's specifically designed for buying, selling, and holding investments such as stocks, bonds, and mutual funds. Now, onto the question of how to choose a broker. This is a critical decision and one that should not be rushed. While there are numerous brokers to choose from, it's important to consider factors like the broker's reputation, the trading platform they offer, the fees they charge, and the level and quality of customer service they provide. Some brokers offer a range of educational resources and tools to help you make informed investment decisions. Others might have lower fees, but offer less in the way of support or tools. The best broker for you will largely depend on your individual needs and investment goals. Now let's talk about the process of opening an account. It's not as daunting as it might seem. In fact, most of the time you can do it all online. You'll need to provide some personal information, like your name, address, and social security number. The broker will also ask about your investment experience and goals. This is to help them understand your risk tolerance and to ensure they're providing the right services for your needs. Once you've filled out the application, you'll need to fund your account. This can usually be done through a bank transfer. The amount you need to deposit will depend on the broker. Some might require a few $100s, others might require several thousand. Remember, this is your money we're talking about, so take the time to read through all the terms and conditions. Make sure you understand the fees you'll be charged and how to manage your account. With a brokerage account, you're ready to purchase an S&P 500 index fund or ETF. The third step involves choosing an S&P 500 index fund or ETF. So what exactly is an index fund and how does it differ from an ETF? An index fund is a type of mutual fund, a basket of stocks or bonds that aims to replicate the performance of a specific index such as the S&P 500. The goal here isn't to beat the market, but to match it. On the other hand, ETFs or exchange-traded funds are similar to index funds, but with a twist. While they too aim to mimic the performance of a specific index, they're traded on an exchange like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices, unlike index funds which are priced just once at the end of the trading day. Now, how do you choose between an index fund and an ETF? Well, it depends on a few factors. Firstly, consider your investment strategy. If you're planning to make regular, small contributions, an index fund might be more suitable due to their structure. However, if you're comfortable with a more hands-on approach and want the flexibility to trade during the day, an ETF might be a better fit. Secondly, look at the expense ratios. These are the fees charged by the fund manager. Generally, both index funds and ETFs have lower expense ratios than actively managed funds, but it's always wise to compare. Lastly, consider your tax situation. ETFs are known to be more tax efficient due to their unique structure, but the impact varies based on individual circumstances. To choose a specific fund, look for one that has a long track record of closely mirroring the performance of the S&P 500. It's also beneficial to choose a fund with a large amount of assets under management, as it's likely to be more stable. Once you've chosen an index fund or ETF, you're ready to make your investment. The fourth step is making your investment. After you've opened your brokerage account and chosen your preferred S&P 500 index fund or ETF, it's time to make your investment. The process is quite straightforward, but it's essential to understand the steps involved. First, you'll need to log into your brokerage account. This is your personal portal to the investment world. It's where you can access detailed information about the index fund or ETF you've chosen, as well as make trades, track your portfolio, and monitor your investment's performance. Next, navigate to the trade or buy section of your account. Here you'll need to enter the ticker symbol of the S&P 500 index fund or ETF you've chosen. This is the unique sequence of letters that identifies each publicly traded security. For example, if you're investing in the Vanguard 500 index fund, the ticker symbol is VFX. Once you've entered the ticker symbol, you'll need to specify the type of order you want to place. A market order will buy the fund at its current market price, while a limit order allows you to set a specific price at which you want to buy the fund. Then, you'll need to decide how many shares you want to buy. This will largely depend on your budget and your investment strategy. Remember, it's not about how many shares you have, but the value those shares represent. After you've entered all the necessary information, review your order carefully. Make sure everything is correct, from the ticker symbol to the number of shares. Once you're satisfied, confirm your order. Your brokerage will then execute the order, and the shares of the index fund or ETF will be added to your portfolio. It's important to note that the transaction may not be immediate. It depends on the type of order and market conditions. And there you have it. You've made your investment in the S&P 500. But remember, investing isn't a one-time action, it's a journey. After making your investment, the final step is managing your portfolio. Now that you've made your investment in the S&P 500, it's crucial to keep an eye on it. Remember, investing isn't a one-time event. It's an ongoing process. Your portfolio is like a garden. It needs regular attention and care to thrive. So what does managing your portfolio entail? It involves three key aspects: monitoring your investment, rebalancing your portfolio, and reinvesting dividends. Let's start with monitoring your investment. It's important to regularly review how your investment is performing. Is it keeping pace with the market? Is it meeting your financial goals? While it's not necessary to check your portfolio every day, a quarterly or semi-annual review is a good practice. Next, we have rebalancing your portfolio. This is the process of realigning the weightings of your portfolio of assets. Over time, some of your investments may perform better than others, and this can skew your asset allocation. By rebalancing, you ensure your portfolio continues to align with your investment goals and risk tolerance. For example, if your original asset allocation was 80% stocks and 20% bonds, but due to market fluctuations, your portfolio is now 90% stocks and 10% bonds, you would sell some stocks and buy some bonds to get it back to your original allocation. Last but not least, we have reinvesting dividends. When your S&P 500 index fund or ETF pays out dividends, you have the option to use those dividends to purchase more shares. This can significantly enhance your investment's growth over time through the power of compound interest. Remember, investing is a long-term game. Don't get swayed by short-term market fluctuations. Stick to your strategy, stay patient, and over time, your portfolio should grow. And that's it. You've now learned how to invest in the S&P 500. Investing in the S&P 500 is a strategic move that can pay off in the long run. We've walked together through this journey, demystifying the process of investing in this powerful index. From understanding the basics, to research and planning, opening a brokerage account, selecting the right S&P 500 index fund or ETF, making the investment, and managing your portfolio, each step is a vital cog in the financial mechanism of building wealth. Investing is not a sprint, it's a marathon. The importance of patience and consistency cannot be overstressed. The market will have its ups and downs, but remember, the S&P 500 has historically provided steady returns over the long haul. It's about playing the long game, staying the course, and allowing the magic of compound interest to do its work. And let's not forget about diversification. By investing in an S&P 500 index fund or ETF, you're spreading your investment across 500 of the largest companies in the United States. This diversification can help to mitigate risk and provide a more stable return on investment. Remember, it's not about timing the market, but time in the market. It's about regular, disciplined investing. It's about understanding that there will be good days and bad days, but overall, the trajectory of the market has been upwards. In conclusion, investing in the S&P 500 is an accessible and strategic way to build your wealth over time. It's a journey that requires patience, discipline, and a long-term perspective. But the rewards can be significant, providing a path to financial independence and the ability to shape your own destiny. Thank you for watching. Remember, investing is a journey. If you found this video helpful, please subscribe, like, and share it with others who might benefit. Until next time, happy investing.